will now be recorded.
All right, good morning, folks. Welcome to today's 7:30 webinar. It's Elliot on the mic, and today is Thursday, the 18th of December. Hope everyone's had a good evening. We'll have a look through the calendar, and then we'll have a look through some profiles. We'll see if there's anything that is cropping up for today that could be worth a potential trade. Just a reminder, today's midday webinar is going to be slightly earlier. It'll be Paddy with you, and it will be at 11:40. 20 to 12, as we'll try to trade and have a look through the Bank of England's rate decision as that comes out. So just heads up, that is going to be slightly earlier. For the calendar then, we have got the Bank of England. That is going to be the first main hitter for today. We have got that at 12 o'clock. Expectations for this are that we see a cut in interest rates of 25 basis points. Now, the probabilities are pretty high that that is the case. It's unlikely that they're going to deviate from this consensus. The only other potential that has cropped up is going to be a 50 basis point cut. Unlikely that, it's decreased since yesterday, so it's pretty unlikely that ends up. However, it is unlikely that's going to be the case, but it may well indicate that there could be some more dovish sentiment coming out. Now, there's a few different ways in which we can gauge the sentiment from the Bank of England. We can either look towards the meeting minutes, the policy summary, which is going to be a report and a speech after the rate has come out, as well as the voting of the members. So we can see through the 9 members, wherever they all voted, have they voted for rate cuts, rate hikes, or rates unchanged for the decision. So what we might see, we did have that unexpected drop in inflation, so that could put the Bank of England in a better position to possibly take a more dovish stance. Right, there seem to be quite eager to cut rates and seem to be quite eager to maintain a dovish stance, even when inflation was still at 3.8%. So the fact that it has dropped further than expected puts them in a position where, although it's still relatively elevated, puts them in a better position to have that slightly more dovish stance. So we'll be looking out for the minutes, we'll be looking out for the policy. Again, rates unlikely to deviate from the 25 basis point consensus. But if we see the kind of the easiest visual thing to see off the bat is going to be the voting. So if we see actually they're expecting 4 members to vote unchanged, if they have 2 members voting unchanged, and then 7 members voting for a cut, that shows quite clearly and quite quickly that there is a dovish tilt that's happened. So looking out for this, that is probably going to drive the move here. Again, if we get those members voting for rate cuts, that would be more dovish. That would be a weaker sterling, and that would be a stronger index. We did see some pretty big reactions from the UK inflation data, the main metric that has been holding the Bank of England back in a way of rate cuts. FTSE had a pretty nice move up for yesterday. I'm not sure if it's held those highs, not really. Hasn't held those highs, but it gives us a good potential to look at those profiles and see what have we got for this day. So we'll have a look at those in a moment. So it may well be the continuation of this FTSE if we can see that breakout. Obviously, it's tricky to enter this trade now because the rates are yet to come out, and it's not guaranteed that they'll have that dovish stance. So it's a bit too risky to jump in unless you were to maybe take an options trade, but you're still taking the risk that that data comes out against us. We're still within this longer term option that we've had a look at a little while ago. That trade we had from the 21st of November kind of chopped around for some time and has since broken out from that inflation data. Again, this could see that kind of drive back up towards or possibly through the all-time highs if we do see a much more dovish tilt from the Bank of England. So looking out for the FTSE, and again, sterling regained a bit of the losses from yesterday, but yeah, regained some or if not all of the losses from yesterday. After that inflation data, still up against the Japanese yen. I think that'll be an interesting one for overnight tonight. Yeah, so I mean, Japanese yen certainly could be an interesting trade, potentially an options-based trade, a week-long contract. In fact, we'll put one on whilst we're here. Markets are still selling off the yen, despite the more hawkish outlook for the Bank of Japan. So that could be a potential. I mean, the last time this happened, we had those moves against the Japanese yen with the expectation for them not to increase rates, despite there being lots of communication that they would, was over here. We spoke a little bit about this when we looked through the options recap. This was the move down we had from that transition out of negative rates. So we could be looking at a similar thing, possibly. It does depend on, obviously, if they do a hawkish hike or a dovish hike, meaning if they increase interest rates, but say we're never going to increase rates again, that would probably have the opposite reaction to what we would expect, which could certainly be a potential. Which is when options can become quite useful. We can at least cover ourselves for this potential move, but if it goes against us, then we aren't going to lose unlimited amounts. We're going to be capped at our loss, but we still have the potential to capitalize on that move. And since there's two pieces of data, inflation and interest rates from Japan overnight, it could be choppy before finding direction. So we'll have a look at that in a second. What's your on sterling strength versus dollar CAD? Sterling looks more dovish. Yeah, sterling does look more dovish. It may well just be general market moves on the back of we've had that big sell-off. It is not unlikely that we see that reversal of an initial data move. Inflation is still very high, right? It's still at 3.8%. We are going into the Bank of England. It might just be offloading a bit of risk, but it's quite likely that we see that initial drive lower, a bit of a retracement through, and then a continuation back in that direction. So that can be the case with these datas. So you've got to be a bit cautious when you are taking those trades. I would say the Japanese yen is probably driving the move here. And yeah, all our other currencies have kind of just made it up towards where the previous pre-release inflation price was. So today we'll drive that move, right? We'll be looking for the markets have moved from the inflation data, but more on the expectation of what does that mean for the Bank of England. It's not inflation itself that's really causing that move. This is how inflation's come out, and what does that then mean for the Bank of England going forwards? So that's obviously today, right? That's going to be the driving factor for longer term strength or weakness in sterling. Yep, today's 25 basis point is, as well as this potential for that split within the voting members. That's already priced in, so we're really looking for a deviation of this. Now, again, with that lower than expected inflation data, that does put them maybe in a better position to cut rates further, or at least maintain a dovish stance. So I would probably lean more on the side of dovishness from the Bank of England today. But we obviously can't guarantee it. So we've got to take it as it comes and don't get too fixated on one specific outcome. Obviously, in this case, I would prefer weaker sterling on the back of all the other data that's come out from the UK. So if this came out and they were hawkish or there was a bullish reaction from the sterling, I probably wouldn't trade that, right? What I would normally do in this scenario is we're going to look at a straddle later today. Straddle, I think Paddy spoke a little bit about this earlier, but we will go back over those options strategies. Straddle is the expectation that before a big piece of data comes out, this market ends up being a bit range bound. Nobody wants to enter a trade right before a massive data release. We don't know how it's going to come out, so we just don't. There's not much trading going on. presents us with a range, which gives us the opportunity to then place an order to go long above this range and an order to go short below this range. A couple of minutes, or as close as possible to that data release as possible, with the expectation that when that data comes out, this market breaks aggressively and continues. Now, in this scenario, again, I think sterling weakness would be a slightly better outcome. So this is sterling Kiwi, not one I would recommend straddling because there's a few different problems with a straddle: spreads, slippages, volatility. Those are all exacerbated when you trade a cross-currency pair that is less traded. So a major pair, I normally trade euros dollar. Not very good for this one, but then cable would probably be the more liquid asset to look at. Hopefully Paddy will go through all that with you later, but if he doesn't, we'll go through all the pros and cons of these strategies, I guess, tomorrow. So, in this case, favouring sterling to be short, I would probably do a one-way straddle in the sense that normal straddle, we don't know the outcome, we're expecting volatility, we're going to take the trade in either direction. In this case, I prefer the dovish outcome, and if it isn't a dovish outcome, I probably don't want to trade that outcome. So I'd put a one order below the price. If it breaks out in my direction, then it's come out dovish, markets are moving lower, and that's what I want to trade. If they come out hawkish, we would hopefully see a clean break to the upside, and that trade would then not be entered. So that's how I would approach it if I had a bit of a bias beforehand. It's 12 o'clock. A little bit later on, we've got the ECB rates. Not really too much from them. I would say, if anything, they might have a slightly more hawkish stance, but they're going to be holding rates, and they're probably going to be holding rates for some time to come. So we'll just look out for any deviation in that, or any hawkish or dovish sentiment within their statements. Probably not one I'd want to straddle quite as much. There's less potential for a bigger move, just on the basis that they're holding rates. They said they're going to hold rates for some time. All their data is supporting that they're in a comfortable position just to maintain this level of interest rates for some time. The potential for them to cause bigger moves or to have a bigger deviation is less likely. So then we have the US inflation data, also going to be quite interesting. I'm not sure if I probably won't trade the Bank of England unless I do an option straddle, just because I find interest rates to be a higher potential to be choppy, because there's the decision, there's the meeting, there's the statement, and then there's the voting. There's lots of things that can contradict one another. So the potential for that to be a bit choppier, I find to be more likely. So unless I'm doing an option straddle, I generally steer clear of that and wait for the aftermath. Something like inflation data, though, highly anticipated, and it is 1 or 2, maybe 4 if you've got the other month-and-month figures, but a few data releases at once. It's one single figure. There's not really much potential for deviation. If they're all going in one direction, it's pretty probable they're all also going in the same direction. And again, it's very highly anticipated. We're looking at a continuation, possibly, of rate cuts into the new year. This is currently pricing in a hold. Sorry. This is currently pricing in a hold, but Trump has said that he's going to be, where is this? Announcing the Fed chair soon. Believes in lowering rates by a lot. They're announcing aggressive reform. So, all pretty dovish from Trump. Now, that's all good and well, and he's obviously going to get someone to probably do that for him. He's not going to appoint somebody that isn't going to do his rate cuts as he would like them to be done, which kind of completely goes against the entire idea of the Fed being a separate entity that isn't ruled by government. But there you go. He's going to put someone in there that's quite dovish, and they're likely to cut rates. That will be in the new year. he'll be appointing them. I don't know exactly when the changeover is, but I assume it's in the new year, fairly early doors. So we can expect some more dovish commentary out from the Fed going into next year. That inflation data is obviously quite high. It's 3.1, not quite as bad as ours in the UK, but it's still quite elevated above what they would want. The rest of the data has still been okay, but erring more on the side of rate cuts. So if we do get that lower print, similar to the UK, that is kind of the limiting factor at the moment, is stopping those rate cuts. So if we can see that bigger print, that has a much greater potential for US dollar downside or equity upside. So for that, I'll probably look to trade this at 130, either euro dollar or maybe the Nasdaq, but euro dollar generally I get the best entries and the least slippage. So I might stick with that. Yeah, 3.1, under 3.1, dovish Fed, more rate cuts, weaker dollar, stronger equities, a higher print above 3.1, a more hawkish Fed, less chance to cut rates in their next meeting, and a stronger dollar and a weaker index. We also got initial jobless claims at the same time. Again, weaker labour market, more jobless claims would put more pressure on the Fed to cut rates sooner. Weaker dollar, stronger indexes. For jobs data, I generally steer clear of trading indexes. I prefer to trade the currency just because there's a bit of a conflict of interest, I would say, for a weaker job market but stronger indexes. So that is this afternoon. Then to the evening, we got the ECB conference. We've then got import-export status from New Zealand, and then we got the Bank of Japan's inflation and interest rates. So that is what we are looking for today. A pretty busy day. There's quite a lot going on. Lots of potential for trading this data. If you want to practice trading data, whether it's options or otherwise, this will hopefully give you the chance to do so. Just on the data from yesterday, or a bit of a headlines from yesterday, we obviously had that sell-off in stocks. Pretty big sell-off, in this case in US equities mainly. S&P was down, Nasdaq was down, Dow Jones was down, but it's still very much within this uptrend. It's probably the nicer setup for a long continuation in comparison to the others. We were looking at this potential bounce yesterday, but didn't take it in the end. Russell as well started to break some structure. So in terms of long opportunities, I'd say that Dow Jones looks the nicest. But where was I? So yeah, just on kind of causes of this, there was the tech sector being the underperforming area for the day. Oracle's data center deal was going through some turbulence, so that caused a bit of a sell-off in that area. We also saw Nvidia also lower on reports that Chinese researchers are working on their own prototypes ready to be developed in 2028. Just in terms of adding competition there, we had Google said to collaborate with Meta and expand their use of AI chips, also weighing down on Nvidia. So tech leading the way for that sell-off. And there's obviously quite a few things there that weighing on those areas. This is quite a good newsletter. You can subscribe to this for free. It just gives you a morning and afternoon European market open and US market open rundown of all the different points, as well as a bit of a listen. You'll do a small podcast style rundown as well, so you don't have to read it all if you don't want to read it all. That's also on Spotify if you want to look at that there. Okay, so let's put on a option for the yen quickly, and we can have a look at this through to tomorrow. Do we have another one on? No. Okay, so let's have a look. Let's go dollar yen. We're a little bit limited by the number of assets we can trade on the options for IG. If you choose to go down the road of options a bit further, IG recently acquired Tasty Trades, which is another trading platform, US-based options trading platform. So this one, they're quite good. I've used this platform, and it's more advanced. There's more things you can do. So if you choose to go down this, you can open that account through IG. So I'd recommend that later down the line. For now, IG is absolutely fine to get started. So let's just make a little bit of an idea so we know what we're doing. And I've got a bit of spreadsheet here that can also help to give us a better understanding of the pricing. Somewhere. So we're going to trade the possible downside of the Japanese yen. So we want to see weakness in the yen, sorry, the downside in dollar yen. We want to see the strength in the Japanese yen on the potential for a hawkish Bank of Japan. What contract am I going to want to take for that direction for this trade? A stronger yen on dollar yen. What contract would I want to trade for that option? Yeah, absolutely. So we're going to be looking for a put contract. Again, a put gives us the right to sell the underlying asset. In other words, a put would say, I'm going to reserve this price level, and at any point between now and the end of the week, we're going to do Friday, we have the right to short essentially back at this price level. So that's going to be the contract we want. We want yen strength, so dollar yen down. Let's just make a rough target area. It's worth having a bit of a target zone in mind, just so we know if a contract is too expensive and the cost of that exceeds the target distance we're looking at, then there would be no point taking that trade. We'll look more into that when we put it on. So let's roughly say this is the area we're thinking about. If it does come out hawkish, it might get there by the end of the Friday trading. So options, let's find dollar yen. We need not the daily expiration because this is going on overnight, so we need a weekly expiration for the 19th, which is tomorrow. A little bit more expensive on the basis of time value, but we're looking for a larger move anyway, so it's fine. We are looking for the downside potential here, upside in the end, so we're going to be buying a put contract. Again, it's buying and selling doesn't necessarily mean long or short here. We're looking to either buy a put or buy a call. That is then long, and this is short. So buying both sides. In this case, we're only going to do one side, but we want to be long and short, we'll be buying and buying. So we want a put contract. Now, there's multiple areas in which you could buy a contract. You can either buy a contract at the money, which is one of the two strike prices just above or just below the current price. So the current price is trading here. I can reserve the price just up here, or I can reserve the price just down here. Now, the contract just up here is going to be what's known as in the money, ever so slightly. These two are at the money, but in the money means the contract is already running at a small profit. Right? The current price is here, and I have the right to sell here, so it's already in a small amount of profit. This contract is ever so slightly out of the money, meaning it is not yet in profit. There is a name for this idea, something value. Does anyone know what it is? Two types of value that are inside of a contract that go into the pricing of a contract. Didn't quite get onto that for our recap, so don't worry if not. This would be known as the intrinsic. Sorry, terrible writing. Intrinsic value. Intrinsic value is essentially, is this contract already running in profit? So in essence, I could buy a contract, and one thing about the options ladder is the strike price increases as it goes down and decreases as it goes up, which is, I'm not too sure why that is, but Quite annoying. So we've got 1.160 down here and 150 down up here. So just keep that in mind if you're looking for a particular strike price. These are levels above the price, these are levels below the price. So I could, basically, the price is trading here. I could, if I wanted to, reserve the price level up here to sell back at. Now, this contract is already in a lot of profit. It already has this much intrinsic value. Essentially, intrinsic value is the difference between the current price and the strike price. Some contracts will have no intrinsic value. For example, a contract down here would be, this is the current price, and I'm reserving this price to sell at. This contract has zero intrinsic value because the contract is not yet in profit. It has to travel all that distance to get to that price that we can sell at, and then it starts to be in profit. So for these contracts, all of the value, anything above this line, for us in this context, all of the value on these contracts is coming from what? Because it's not coming from the profit, because it has none. Whereas these ones have got profit value. What's the other value that is going into these contracts? Yeah, absolutely. So all of the value here, 47.1 is, and I mean, there are other variables that get priced in, but a majority of that is going to be time value. 47.1 pips worth of time value, because this contract holds no intrinsic value. So let's put one on. So we're going to be looking at one of these two. We can either go for the slightly more expensive in the money, slightly less expensive out the money, or a very out the money contract. Now, this is where something like this could become useful, just to compare those different contracts. How do you define in the money? Yeah, so let's have a quick look here. Might make a bit more sense on the chart. So the current price is here. We are looking to reserve a price at this level, around this level, to sell back at. In other words, we're going to be buying a put to reserve this price level so I can short back at this level at some point between now and the end of the week. Now, I could also buy a put that is down here at this price level. This would be known as a out the money contract, meaning it has no intrinsic value, it has no profit already. This is going to be cheap, right? A cheap contract, I could buy more of this contract, and we'll compare a couple in a second and see actually what would that mean for us. But the buying of a put out the money means it's not yet in profit. This market needs to move all of that distance first before we actually get to a point where I could use that contract. This contract here would be at the money. Also written as ATM. At the money, it is at the current price. Possibly a little bit of intrinsic value, possibly a little bit of not intrinsic value. Most of the value is coming from time anyway. So at the current price, it's more expensive, but not crazy. And then a in the money contract in this context, this would obviously be the other way around if I was buying a call contract, because I'd be long. If I buy a put in the money, this is a contract that is already a large amount of intrinsic value. And that's going to be the most expensive. So it's in profit. Okay? So this one's going to be most expensive, which that's basically saying that the price is here, and I can reserve this price level right now to sell back at. So this contract is already in this many pips worth of profit. So I firstly, in terms of contracts, I have to pay for the usual time value. I have to pay for the usual implied volatility and the potential for this to continue moving. And I also have to pay for the difference that is already in profit. I have to essentially buy that profit. So yes, you can reserve a price to sell back at, but it's going to cost you a lot more. So you still have to travel a large distance to earn back what you've paid. Now, my preference would be one of these two, either at the money, reasonably priced contracts, the most commonly traded, or out the money, in the hopes that I could buy a much, much larger sum of contracts. So every move of this market below my strike price would be a much greater profit. Now, this would be a good contract to use if you're expecting some kind of black swan event, a big, enormous move. So I'm going to buy 1,000 contracts out the money. So let's just say, yeah, out the money. So for every pip I move down here, I'm going to make a load of money. This contract being a more kind of normal sizing. Has already in profit if the price is below it. So this would be, so if we were to draw this out as boxes, this contract allows us to sell back at this price. So that would be our profit line. This contract, if we're taking the same target in mind, allows us to sell back at this price. And this contract allows us to sell back at this price. So the in-the-money contract is already in profit by this amount. All right, if we have a look at the different strike prices here, I could reserve a price level at the highest price is 167, which is up here. I'm not too sure why I would want to do this. So I could buy a contract to sell dollar yen at 167, which is up there, which is enormously in profit already. But you wouldn't really, you wouldn't really have any reason to do that. That is already in 1,100 pips of profit. So the contract price will be 1,100, and then 12 as time value and the rest of it. So I'm paying for the profits already in, and then I'm paying the rest of what a contract is normally worth. So that would be the different states that a contract can be in the money, out the money, or at the money. That makes sense? Again, the ones you'd probably want to focus on will be at the money normally, and maybe out the money if you want to try and, in fact, we'll compare some now. So let's just take a couple of strike prices here. So for this table, we're going to put in the option type, which is a put contract, and we'll do 3 different contracts. We'll do a at the money contract, an out the money contract, and an in the money contract. So it's hard to compare strike prices quickly together because it's hard to compare which one's going to be the most profitable. Current prices around here. Whoops. Don't really have to type the current price in, but we'll put it in anyway. Target price that we've got in mind is 15450.7, which is the low of that recent big swing. 54507. That's our potential target area. The strike prices then, which prices do we want to reserve? Now, let's take the at the money price, which is, we'll do the slightly cheaper at the money price, which is 15550, which has a distance of 99 pips to the target area. We'll use an out the money contract, such as, let's go for a target 54. That is just the big recent low on price. Just these big lows. If that comes out super hawkish, it might go further. It might not make it that far, but that's a big area of support to aim towards as a starting point. Now let's go, this obviously starts to plateau out, so let's go for this one there. No, that's too far. Yeah, that's too far. Okay, so this is our target price. Okay, let's pick a slightly further away target just for argument's sake. Let's go for. I'm not expecting it to necessarily get here, but let's just use this for argument's sake for this example. 15283.1. Okay, now let's use that cheaper out the money, which was 7.2 pips for that, which is 15350. That's it. Okay, cool. And then we'll use an in the money one. Let's go for a relatively expensive one. Let's go for 224. Let's go for this one too. 15800. We've got three different strike prices here. In the money, out the money. Out the money, yeah. In the money, out the money. Yeah. So out the money, out the money, in the money. Now we've got to put in the options premiums for these. The in the money one was 223.2. Out the money one was 7.1, and the at the money one was 45.5. Now from this we can calculate how far does this market need to move in order for me to earn back what I've paid. These are priced in pips, so I've paid 223 pips for this expensive contract, meaning this market needs to move a minimum of 223 pips in order for me to make any profit on this trade. Now, we'll do the same risk on all of these of roughly £1,000, which would be two, one, 40, one, and 0.5. Cool. Okay, so all of these have got a similar risk: 1001, 1001, 1004. We can see the difference in size here is pretty big. So, in terms of pounds per pip, the sizing of this position, I've got 22 pounds per pip for the at the money contract, 141 pounds per pip for the out the money contract, and only 4.5 pounds per pip for the in the money contract. So, a very large difference in size. The good thing about options contracts is the margin requirement to take this trade is the maximum risk that you are taking on the trade. So in a normal position, let's just take the £141 per pip, for example, which is this one. If I was to do 141 as the size, the risk of my trade is £1,015. That is also the maximum amount of margin that I need for this trade, which is very small. If we look at the same size in the price, which was 141, I would need £73,000 worth of margin for this. Now, the notional value of that trade in terms of the actual monetary amount that this trade is worth is 2.19 million. So options contracts aren't leveraged in the same sense. I don't get a 1 to 30 leverage that I can then buy contracts with, meaning your buying power is your buying power. You're buying the contract. This contract costs £100. I have to pay £100 to get that contract. There's no leverage used in that transaction. However, an options contract itself is inherently leveraged, meaning a contract is worth a certain amount of an asset. 100,000 of an underlying currency pair, 100 or 1,000 shares, 100 barrels of oil. A contract is a set amount of an asset. So although you're not using leverage to buy the contracts themselves are inherently leveraged. Anyway, what this means for us is we can control £2 million worth of this asset for only £1,000. If I wanted to take this trade normally, I would need to have £73,000 in my account in order to take this trade. And if we had the same stop loss on our trade for this, which is 1001, that would be the size of our stop loss. Pretty small for the same amount of risk. Right, so options contracts allow us to control a much larger amount for less, which is obviously not a bad thing. And your risk is limited without having that tight stop loss. So happy days. Okay, so in terms of profit then. So the break-even prices for this trade are lined up here. So it is taking, in this case, it's taking the premium and it is subtracting it from the strike price. So it's, in this case, 15283, no, strike price. Oh, 15550 minus 45.5 to give us 15504.5. That is the distance that this market needs to surpass in order for us to start making profit, because then I earn back what I've paid, which is 45.5. Now, in terms of risk to rewards here, what we're actually looking at, so in terms of if that market were to make its way towards our target level at the end of this period, and again, I'm not expecting it to go this far, but just for example's sake, if we get to that target area, our at the money contract would return a 6 to 1 or a 7 to 1, £6,000, 6,800 pounds for the 1,000 risk. If this market makes it to that target with the out of the money contract, the cheaper one is at a £2 million size, we would do a 10 to 1, which would be 10,434. If the market makes there on the in the money contract, more expensive, smaller size, we would only make a 3 to 1 or 3,300. So the out of the money contract in this case would be the most profitable because it's the larger size, but we are then expecting that the market is going to make a abnormally large move. So if you're expecting a move like that for whatever reason, an out of the money contract might be a better place to look. Yeah, I'll attach that spreadsheet to the email for the recording. So yeah, if we're expecting that big move, out the money is going to be better. If we're not expecting that big move, let's just change the target level here quickly. No worries, Scott. No worries. Catch you later. Cheers. Let's take then the closer target of, let's do 15440. So where is it? 15440, and see how these compare now. This one, it says positive. I haven't quite figured out. It's just keep in mind what you're actually looking at here. This would be a loss in this case. These say negative because it's a put contract, but that would be profit. In this case, if it's a put contract, it should say negative. If it says positive on a put contract, it means we haven't surpassed our break-even zone. Break-even zone here is 15342, and the strike price, target price is 15440. So we wouldn't make that contract into profit. For the other two, the at the money is still more profitable than the in the money contract for the tighter, closer target. So that would be a few different contracts. Now we're just going to do the at the money contract because we're not expecting that completely enormous move. But if it does go, then fine. So let's put one on and we'll see how it looks. So buying a put contract. Then it's always worth putting these lines onto the chart just so you can visualize what does this trade look like. Now we've got a couple of things that we'll need to note down here, which is going to be the strike price 15550, and we'll want to put down the opening cost, which was 46.1. The opening cost, the strike price, and then we can work out our break-even zone. If you were to click on this position, it's going to open up a chart, which you don't really need to look at. This is just a chart that shows you for this strike price, how did previous contracts end up? Did they end up profit? How much were they worth at the time of expiration, at the time of opening? Again, not really too much to look into there. So if you find yourself on this, you can just get rid of that. Now let's put these levels in. So our strike price was 15550, which is pretty far down there. The difference or the increments of strike prices is less on higher, longer expirations. So for a daily contract, I might be able to get one closer to the price. Weekly contracts, that's the closest we could have got on that side. Then we need to do our break-even zone, which in this case, we need to do our strike price minus our cost, which was 46.1. Which is going to be 15503.9. That's our break-even zone. Now we can add this to the chart so we can visually see where does this market need to get to in order for us to actually start making profits on that trade. It's a pretty big distance, right? That's a pretty big break-even zone, which is the problem then with options, is going to be the cost associated with them. That would be the trade essentially. Strike price is up here. This is where I'm going to have the ability to sell back at. I have to exceed this red line to earn back what I've paid, and then that would be my target level below. So we'll leave that on in the event that the Bank of Japan ends up being more hawkish than expected. And yeah. If there's any questions on that, feel free to ask. If not, we'll have a look through a couple of profiles. See what we got for today. So obviously a good thing to look at in the morning, first thing, in case there's any setups that are currently starting to form. Now, there's a couple of nice looking, looks a little bit better on here to be honest. But so the NASDAQ has a relatively nice looking profile. Double distribution is always quite a nice profile to trade. We've got a few other confluences lining up here. So let's just use a bit of a checklist here to go through what we've got in terms of signals. So, previous day's profile, we have got a double distribution. Now, a double distribution is going to be a little bit more of a neutral shape in the sense that it's either bullish or bearish in the context of where it's found. In this context, it would be hopefully bearish for us, and we'll have a look at why that is in a sec. Point of control location from the previous day is down, and it has been lower for 3 consecutive days. That would be bearish. Thin volume areas, this probably you might want to adjust. Yep, no problem. I'll send this across as well. We have got some thin volume down there, to be fair. So possibly some thin volume below and a little bit of thin volume above. Now you might want to adjust how this comes up and shows on the spreadsheet. I've got this essentially, if there's thin volume above the current price, it would be bullish in the sense that that will normally attract price towards it, which will come up as bullish. And in this case, I don't think that really is entirely, I mean, it's correct in the sense that we've got a double distribution. Expectation is that the market will likely fill this zone, but we're going to want that to be the case in order to take the short position off that level. So yes, the initial move is bullish, but the continuation of that move is likely to be bearish. So you might want to either not use that or just keep that in mind. Open from the value area. We are within the value area, so there's not really too much to look at there. So not a great deal. There was no gap on the price as far as I can see. There's no gap. There's no initial balance for this at the moment. Okay, so it ends up being actually not that much going on. The overall trend here is bearish. So we've got the hourly trend is down, so that is bearish down here. We can also then add, say, a moving average if we would like to. Are we above or below a moving average? In this case, we would be below, which would then be bearish as well. Then we can look at the market profile. So market profile, we're going to be looking for, in terms of directional confirmation, 2 points that we looked at yesterday, which would be, what would those be? I can't remember. 2 levels that we can use for directional confirmation. Yeah, absolutely. We're going to look for excess. And one other. And poor high and low. Perfect. We just got to adjust this a little bit so it comes up the way we want it to. I got the wrong way. There in the end. Okay. So this is our market profile. Now, a few interesting points to take away from this. Really depends on how you would categorize these. There is a single TPO at the top of the day. Whether or not that would constitute excess for you, I would probably want to see at least 2, but it does still show that rejection off the highs, which is good. We've got 2 TPOs at the bottom. Again, whether or not for you that would constitute a poor low, I probably want to see 3, but it does again still show that dynamic of an inability to trade at the highs and that ability to trade at the lows, or the aggressive sellers and the inability of buyers to push away. So we'll put this down as excess and a poor low, although it's not quite as strong as I would realistically want. Excess above and poor low below. So now we've got a double distribution, which in this context would be bearish. We've got the point of control, which is lower, which in this case would be bearish. Thin volume above, which the initial move bullish, but then hopefully it will reject off and become bearish. Excess above, bearish. Poor low, bearish. Open from value area was inside, so not really too much to take away from that. Initial balance comes at 230, so nothing there. And the hourly trend is down. We would be below a moving average. So there's quite a lot of bearish sentiment going on here. So overall, bearish for this profile, bearish for this day. That can be the directional bias that we take for the day. Do keep in mind we have got data coming out. Now we need to just think about how am I going to execute this bias. So we've got this big area of thin volume. With a double distribution, the expectation would be the market comes to fill this zone, and then we trade, hopefully, off of it. So we can use this area. Now it's quite a big zone of low volume. One thing that I quite like to do if there's a large zone of thin volume would be, I suppose we've got a similar example here where we've got this whole area could be a big zone of thin volume. Knowing where and when to take that trade inside of the zone can be tricky. So what you can look for is actually to refine the area slightly, make it a bit smaller, using single prints. So where does the single print and low volume overlap? So we can look at a slightly smaller zone and be a little bit more efficient about where we are looking. Now the same is true here, although I don't think those single prints are much smaller than the low volume. But let's take those single prints from the volume market profile. A little bit smaller, but not massively. So where these two overlap is going to be that zone of interest from the profiles. Not really too much else to take it. Another thing we have got is the points of control at the low of the day. So if this market moves up, doesn't get accepted at these higher prices, rejects off these levels, we can also trade back down towards yesterday's point of control. Now, we can also look for our normal analysis. So we can look for, have we got an area from the fib retracement? Yep, that lines up pretty nicely within this zone as well. So we've got the single prints, low volume, also fib retracement. We have got a round number a little bit higher up within this zone. So 25,000 would be a round number above. So a psychological level of resistance, possibly a zone to keep in mind. Or yeah, I guess that'd be it. A slightly closer level of resistance. We've got two potential levels here, would be maybe that one below there, but that doesn't quite line up with the fib retracement. Nonetheless, this ends up being a zone that's got multiple confluences, multiple areas of potential resistance. We've got single prints, low volume, fib retracement, and some areas of resistance that we could be looking for in this case. Now, we obviously don't want to make the assumption that this is going to trade off this level, so we would need to be waiting for, and if we look at this last example, we would need to go down to our execution time frame once that price gets into that area. Once it gets into the zone, that's when we're going to be looking for any kind of confirmation through maybe a breakout of a trend line, counter trend line, a bit of rising wedge, if there's a head and shoulders, if there's an area of resistance that is formed, any breakout that supports sellers stepping in and sellers driving that price lower then provides the entry. Right? We're not trying to assume that price is going to move. We're trying to react to the market moving, right? So we're not trying to predict exactly what's going to happen. We have just got a level that could see selling pressure, and if that selling pressure does present itself, then the opportunity comes around, not the other way around. So that could then be something like this. If this trade were to get to that level at, say, 120, so inflation data is coming out, this market moves up, tops around here until the CPI comes out. This is again when you could use a one-directional straddle style setup. So in that last example, the trigger to enter the trade, the thing that confirmed the bounce, was the break of a counter trend or the break of a price pattern. That is the trigger event to enter into that position. Now in this case, the trigger event could be the inflation data. So just before inflation comes out, provided we are where we want to be, I'm going to put my order here, stop loss wherever, target down here. If that inflation data comes out stronger to support a more hawkish Fed and indices then dropping on the back of this, that supports the trade idea and would enter us into the position. If that data comes out weaker and we see a dovish reaction, hopefully this market would break relatively nicely to the upside and we would not be in that position. So we could use that data as a catalyst to enter the trade. That's kind of what we could look for on a kind of day-to-day basis from those profiles. Now the S&P, presumably similar setup, point of control not quite as good. The Dow Jones, a nice B-shaped profile, maybe trade up towards point of control. If we get a slight deeper pullback, maybe thin volume that lines up with our trend line up here. To continue. Alternatively, if we start to break out to the upside, then obviously have a look tomorrow for a bullish profile to then trade long if inflation comes out lower. And yeah, let's see if there's anything on the sterling pairs from yesterday's profiles. Again, something like this could be quite interesting. Zone of thin volume, which we are approaching at the moment, a P-shaped-ish profile, if not double distribution, but still points to control at the high of the day, so bullish sentiment from that. Trade into here, potentially trade off to go long. You don't need to overcomplicate these, especially at the start. When we're taking these trades, it's obviously important to try to take some trades off the profiles. Don't try and do everything all at once. Find a zone of thin volume, look at a point of control. If it gets to that point, take the trade. We looked at some setups yesterday, which involved if the market opens above the previous day's value area, we could take a rejection off the value area high to go long. That is a trade you can look for fairly early doors in the morning. this happening too early, unless you're trading at 12 o'clock. But that is a simple trade you could take just to get some practice in the profiles. Are we approaching any kind of level? I just take a bit of a trade-off one. Yeah, let's look at that. Cool. Nice, yeah. So similar kind of idea there. So we've got, yeah, point of control on the previous day. We've got a nice zone of single prints there. It's just broke above those single prints, so maybe make its way to the next. This is also presenting that setup that we were just talking about, which is if that market opens above or below the value area, we can wait for the pullback into the value area, high or low, depending on where it opens, to then maybe take that as the rejection. And that is actually lining up quite nicely here. Obviously, there's multiple potential levels we could look for here. Either this market rejects off that zone of value area low, or it makes its way up to the single prints and the low volume, as you identified, and also lines up with a fib, and it might end up rejecting off that. So we end up with multiple possible levels where we could see a nice reaction. This is when we really need to wait for that confirmation on the breakout. If we don't wait for that breakout confirmation, we might enter the trade on an early bounce before we've actually got enough confirmation to say that it's turning off that level. When we have got multiple levels like this, taking that breakout is all the more important to confirm the bounce that we're looking at. Yep, no, that was good. Deepak, yeah, that's nice. Good profiles, good levels you got there. Let's see what's doing on the lower time frame here. Yeah, make sure to take that trade if it starts to present a bit of a breakout. Coming off that value area low a little bit, but we'll see. Yeah, nice, good. Just on the spreadsheet, I'm going to send this over. For typing things into the spreadsheet, the colors come up based on what you type in. So there's a bit of a key over here for typing in the correct words. So for the shapes, B shape, it's going to be B shape, bearish, P shape, bullet, P shape, bullish, a 2Ds for a double distribution. Comes in as fairly neutral. By itself, it isn't either bullish or bearish. It's the context in where it's found. A thin day is down as thin volume or vol. Also neutral depending on the context. And a D shape, also neutral depending on the context. So they're all green, orange. Point of control from yesterday is either up or down. Thin volume area, I'm not sure why I've done different wording here, but either above or below as bullish or bearish. Again, you may or may not want to use that. If it confuses you, I would say don't worry about that one for now. Excess, poor highs, poor lows, either above or below, bullish or bearish. Open from the value area, as we were just talking about. The DAX opened below the value area, which is down for some reason. You can change the wording for this if you'd like. Up or down, bullish or bearish. Initial balance, we'll talk a bit about that tomorrow, but that would also be up or down for bullish and bearish. If there was a gap up, this would be up in both of these boxes. Essentially, the initial move after a gap. So market's trading here. If we gap up to here, that initial move is normally going to be bearish to trade into the gap. So if the rest of your bias was to be bearish, you could trade down, but the continued move is normally going to be bullish. So that's why you put up, gap up on both boxes. Initial one is bearish, continuation is bullish through there. Hourly trend, up or down, moving average, I've just added in above or below. And you can obviously add whatever you like into that. There's a few other sections here. There's a bit of a setup area. So if you would like to create your own setup, if you would like to create a bit of a setup for yourself, so write whatever it is you're looking for, gives you a bit of a checklist to go through. In this case, it's got hourly trend, profiles confirming the trend. This is risk on, risk off confirmation, major downtrend, super retracement, hourly trend, and you can put into this whatever you like for the higher time frame, execution time frame, and triggers, just so you are ticking off the things you would like to see. There's a bit of a blotter if you want to keep track of a few trades, if you're doing whatever. There are a few tables on here which seem to, they automatically update, so they should show the current data for whatever the country is. And it pulls the data from trade economics, so it should automatically stay up to date with whatever the data is. See if that is the case here. Where's inflation? That's not right. Okay, it should automatically update. Refresh every. Okay, so you can refresh data when opening the file, which is what I want to do. So that is now correct. This, yeah, for some reason, the connection to the website doesn't seem to carry across when I email it to people. So I'll go through how to set that up yourself, and you can do the connection and then pull the data yourself. But it just pulls together the data from different countries, a few different areas here. There's a risk on, risk off meter through there, an FX correlation table, and a currency table. Again, don't worry too much about those for now. I'll go through how to set those up, and you can play around with that yourself. More this and the checklist. All right, so I think that is probably it. If there's any other questions, feel free to ask. Otherwise, we'll look at that dollar yen trade tomorrow for the options. Look out for those possible pullbacks into the profiles for today, and early webinar on the midday, and then keep an eye out for that data later on. On January the 5th, do webinars reset to week 1 yet? So we have a new code. So we are off for the Christmas break from the end of this week, January 19th. December 19th is the last day, so there won't be any webinars or anything going on. We come back on the 5th of January. That is going to be a new starters day for the next cohort. So, yeah, we'll have to, it'll be week 1 stuff from that, but we'll obviously, webinars will run like usual. January 5th will be day 1 stuff, so introductory, you don't have to worry about joining those. From Tuesday, the 6th, it'll be normal kind of day-to-day webinars, but there'll be obviously a lot more week 1 stuff thrown in the mix. Market profile is only, you have to have the minimum of the essential package. But the market profile one, if you send us your TradingView username, we can add you onto the LAT one, and then you don't need a subscription for that. The volume profile is the minimum of the essentials package. People in week 5 now, and recaps for week. Now, and recaps for week 5 to 8. Yeah, so yeah, we'll continue to do, we'll continue to go through all the other content as well. So it'll be 4 p.m. webinars will probably be week 1 recaps. We'll do the week 6 is the end of the new content, so there'll only be week 6 stuff to recap, and then we'll recap week 6 stuff in and around the other webinars, which is strategy stuff. No worries. If there's any other questions, feel free to ask. If not, give those a go. If you have any questions in the meantime, obviously get in touch. If not, I think it's Paddy with you on the midday webinar, so he'll go through the Bank of England, and I'll catch you all sometime tomorrow. Good to go again. Yeah, absolutely. Yeah, we'll continue to recap all of those. It's not a problem. Cool, perfect. All right, cheers, folks. Thank you very much. Have a good day, and I'll catch you all probably sometime tomorrow. Cheers, folks. Thank you. Bye.